Good morning and welcome to this Wednesday, September 23rd, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we had a pretty good day yesterday. Overall, I was pretty pleased to see some of the growth names return to leadership. I don't think we're completely out of the woods just yet, but I do think that the market is showing some of its resiliency. This morning, we're seeing futures up mostly, but at least at the open, I'm seeing a little bit more of a shift back toward the value stocks. Both Dow and the S&P are higher. The NASDAQ showing a little bit of relative weakness, which has been opposite of what we've been seeing this week. I'm going to get into all of that in just a few minutes. But right now, the Dow futures are up 163 points this morning. Got a really nice report out of Nike after the bell yesterday. That was one I was anticipating that we'd see a good report. Not only did we see a good report, but we're seeing a pretty good reaction as well, or at least we were. So I think Nike continues to look strong. Pullbacks, I think, would be buyable. Another company that I really liked, actually featured this as a possible pre-earnings run-up in the Earnings Beats Digest report, was Cintas. I think that was from about 2 weeks ago. And it went down right to the top of the support zone that I'd provided. And the stock's been running straight up since. Had a really nice report, getting a good reaction this morning. And, or at least, again, it was. And I'll go through those when we get to the earnings spotlight. But overall, market has definitely improved here over the last couple of days. But again, this is the worst week of the year historically. And so I would, give it the attention that it deserves. I do like the action the last couple of days, but I also know what happens this week. And so, again, I don't think we're out of the woods. There's some things that we're going to want to look for to confirm that we're moving higher from here. And I'll talk about that throughout the show as well. All right, let's go ahead and get this thing rolling here. First up, if you're new to Earnings Beats, I always like to make sure you're aware. If you go over to earningsbeats.com, you can sign up for that Earnings Beats Digest newsletter. I just talked about Cintas being featured a couple weeks ago. This is a free newsletter, so simply type in your name, email address, hit the subscribe button. We'll make sure we get that out to you every Monday, Wednesday, and Friday. Typically, it goes out before the market opens, so you have potentially trading ideas or at a minimum, education. I mean, that's really what what we do at Earnings Beats. We really focus all of our products and services around education and just trying to teach all the things that we've learned over the years. I've paid enough tuition for all of us, believe me. And so it's just one of those things we want to give back. And the digest is one of those ways to do that. So if you want to join our community, our growing community, we'd love to have you. Just simply type in your name, email address, hit that subscribe button. No credit card required. You can unsubscribe at any time. One thing that will be featured a lot is relative strength, and that's one of the principles behind our portfolios. We like leading stocks in leading industry groups, and it's going on 2 years. It's unbelievable, but only about 2 months away from 2 years since we started the model portfolio. We had an event back on November 19th, 2018, announced 10 stocks equally weighted, different industry groups. It wasn't like we put 10 software stocks in there, different industry groups. No doubt they were weighted more toward aggressive sectors because I'm very bullish the market. So I think getting into defensive sectors really is just going to cut into your returns. So throughout this period, most of these model portfolio stocks, probably 99% of them, have been in more aggressive areas of the market, but they're in different areas of the market. So kind of giving us a little bit of diversification there. But anyhow, I mean, you can check out that return, 142% in less than 2 years. S&P 500 is up 23%. Nothing to sneeze at there. I mean, 23% is a nice return. But I think that this shows and confirms that the way we look at the market certainly pays off, especially in a bull market. And some might say, well, what happens when the bull market ends? Well, if it's based on relative strength changes when you go into a bear market. I mean, all of a sudden, you're going to begin to see more defensive areas leading on a relative basis. So it's naturally going to throw you into more defensive areas of the market. one of the things you want to avoid doing in the stock market is trying to impose your will on the stock market. That doesn't usually work out too well. The market's going to do its thing. It doesn't care what you think. It doesn't care if you think things are too stretched. It doesn't care if you think that Apple has gone too far and it can't possibly go any higher. If the market wants to bid Apple shares up, it bids Apple shares up. And as long as growth continues to come into the market in this low interest rate environment, I'm not quite sure where the top is. I think we've still got a long way to go to the upside personally. But anyhow, even looking at this last quarter, I mean, up until the last 2 days, growth stocks have not been really in favor very much, certainly not in September. And yet this quarter, model portfolio up 8.5 percentage points above the S&P 500. We're only about 5 weeks into this quarter. And model portfolios outperformed 6 of the last 7 quarters, trying to make it 7 out of 8. So pretty good performance. I just point all this out because, again, if you're new to Earnings Beats, if you come in, check us out, you'll begin to pick up some of the things that we do. And if you want to try our service, click on the Join Today button. But all of these portfolios have their own separate chart lists, which if you're also an extra member or above at Stock Charts, you can take our chart list and download them right into your account. These 4, we've got a strong earnings chart list, which has 484 companies in it, I think. We've got strong accumulation distribution chart list, strong future earnings chart list. All these chart lists you can just drop right into your account. So anyhow, sorry to spend so much time on that, but I know we get a lot of new folks in here. I just want to make sure everyone's aware. All right, moving on to what happened on Tuesday. It was a good day. The Dow Jones and S&P on a relative basis didn't really keep up with the NASDAQ, but that's kind of been the norm in 2020. It wasn't the norm in September until the last couple of days, but it seems to be returning back to that norm. Anyhow, the Dow was up about 0.5%, S&P up a little over 1%, NASDAQ 1.7%, mid caps up almost 0.75%, and the small caps up about 2/3 of 1%. So leadership clearly returned to the NASDAQ. In terms of sector strength, I actually liked the sector leaderboard yesterday. Discretionary, communication services, technology, and industrials for the top 5 groups. Real estate thrown in there. Real estate needed some work. Real estate had moved down to almost a 2-month low, but it did bounce yesterday a bit, up a little bit more than 1%. But discretionary up more than 2%, leading the action. And this is one of the few groups, this one along with, now technology is back above its 50-day. But discretionary and industrials are 2 of the groups that actually have held up above their 50-day moving average. And when you look at the major indices, you'll see that we've been going below that across the board. So on a relative basis, discretionary and industrials both still hanging in there, although I would still throw technology and communication services in as leaders. They had just gone up so much, they took a little bit more of a hit in September. The other thing to keep in mind is the faster a stock goes higher, or a sector or index, whatever, the faster they go higher, the faster their 50-day moving average rises. So when they do go through a period of selling, the 50-day has been moving up much quicker. I mean, look at real estate. Real estate's been in an uptrend, but much slower. And you see the 50-day not really moving much. So it doesn't take much at all selling in real estate to go below the 50-day. Here it took a little bit more, but technology went from almost 130, 128, something like that, down below 110. So, I mean, we're talking about a 15% correction in technology. By far the biggest correction we've had throughout this pandemic rally. And of course, that had that impact on the NASDAQ as well. Anyhow, overall, I think the market looks pretty good, and I like the leadership that we saw on Tuesday. All right, let's get an update on the 10-year Treasury yield in terms of economic reports. Coming up later this morning, actually just reported, I haven't seen it yet, but July FHFA house price index expected to rise 0.6%. June was up 0.9%. And then September PMI composite flash, that'll be out at 9:45 this morning. The estimate there is 54.5. August was 54.7. So looking for a little bit of contraction there, but still well above the 50 level, which is key. Looking at the 10-year Treasury yield, I mean, I just see sideways consolidation. I don't really see anything longer term, clearly downtrend. And that favors the growth stocks. If you've got companies that can grow earnings rapidly in a low interest rate environment, especially one that's been declining, that is nirvana, because you have to think about investors and their alternatives. Where do you put your money? You're going to invest 10 years getting 0.67% per year. That's not a very good return. I mean, not when you've got, here, would you rather be in that, with that yield, or would you rather own Apple going from, 55, 53, whatever, to 135 during that period? That's what choices the investors have. So when you can't really make any money in fixed income, and you've got companies growing their earnings, that the other thing is the earnings become much more valuable. If you want to buy a company and they're growing their earnings rapidly, you've got to pay up for it. It's not the same price. I mean, sometimes people get so focused on PEs, they don't think about the common sense behind them. Price earnings ratio is fine, but what about the growth? A company that's growing 30%, growing their earnings 30% a year, should not be valued the same as a company growing 10% a year. Hopefully that makes sense. And the lower the interest rate environment, the more impressive that 30% growth is. Anyhow, I could talk about that all day, but let's go back to that 10-year treasury yield. So the yield right now is simply flat. And, it's not just about the fundamentals and earnings rising and growth stocks and so forth. It's also about money flows. You've always got new money coming in, 401ks and things, always coming, money coming into the market. But the rotation, the big rotation between fixed income and equities, that is what can really drive the stock market higher. And we haven't really had that. Normally, declining yields is not good for stocks because money's going into treasuries. Usually, and in a bear market, if you saw, you go back to 2007, 2009, when the yields dropped, the stock market, the bottom fell out. Now, when we get the yields dropping, the market hangs in, even goes up a little bit. That's the difference between a secular bull market and a secular bear market. Those who think we're in a bear market are going to be in a bear market are not watching the money rotating. I mean, it makes no sense to think we're in a bear market. And technically, it makes no sense. But anyhow, right now, 10-year treasury yield just flat. If we were to make this breakout, two things. Number one, I think that would really help move money into the stock market. But the other thing is, if we do break out, I think areas that have been beaten down in the past, and some areas have already come back to life. I mean, transports certainly have come back to life a lot. They're going to benefit, maybe even more so than some of these pandemic stocks. And that's going to be one of the things that in the fourth quarter I'm going to watch if we get a breakout in the 10-year treasury yield. Money starts rotating out of treasuries. Where does that money go? Because remember, this is defensive money. Where is that defensive money going to go? And I think it could help some of the poor pandemic stocks maybe outperform in the fourth quarter. I don't know. Still, I got to see how that unfolds, but that's one possibility. Now, I still think everything goes higher. It's just a matter of what goes up the most in the fourth quarter. And it's just my opinion. You feel free to disagree. I mean, that's the great thing about a market. You don't have to listen to me. You don't have to believe me. You can come up with your own ideas. There's plenty of folks, believe me, that think opposite of the way I do about the market. So you got plenty of folks to check out if you want the other side of the argument. But I am very bullish about the market. I think we're going higher. I think over the next decade, we're going a lot higher. And will we have these brief, cyclical bear markets? Yeah, we had one in 2018, end of 2018. We had one, back in March with the pandemic. But you saw how quickly we rallied back. You don't do that in a secular bear market. You do that in a secular bull market. Anyhow, all right, let's keep moving on. Let's take a look at the NASDAQ. So I mentioned earlier, that there are things that I'm going to be watching for to confirm that the bottom is in. Well, one thing that I'm going to be watching for, and this is just basic technical analysis. When your price action is below your moving averages, you're basically you're trending lower. Short term, we're in a downtrend. Even with the strength the last couple of days, we are still in a confirmed downtrend in the short term. And that's why I said you got to keep your eyes and ears open for what might happen later this week, or maybe even the next couple of weeks. I mean, I'm thinking we're going to have a pre-earnings run up. It doesn't always happen. We already had a big run up. Maybe we roll back over again one more time. I'm not sure. But the moving averages here are what I'd be watching, because if we get through and we start to see those moving averages turning back up, that to me is a sign that the worst is behind us. I don't believe we'll go back down lower than we were before. Now, you can go above and be in a trendless market. When you go through the moving averages, then you come right back down through the moving averages, you go back up through, that becomes a trendless, a short-term trendless market. That's very possible. But usually what will happen is if you get back up through the moving averages, that low that you hit, that's here around 10,500, that normally will hold. So as you go back up, if you come back down, I'd be looking for 10.5 to remain as really good support. Now, if we can't get through these moving averages, then that low comes into play, and maybe we do have another low coming. So I just think that the moving averages and how price reacts to these moving averages, not just on the NASDAQ, but many of the growth stocks that we've seen rallies on here the last couple of days are coming up and testing. Some are, Zoom's breaking out. Zoom's just one of those stocks. It's a leader. It's remained a leader. It's continued to trade well. That is not the poster child for all the stocks in the market right now. Most of the stocks in the market, many of the growth stocks look just like the NASDAQ, where we went below the moving averages. Now we're trying to come up above, and we'll look at some of those in a little bit. But that's, from a NASDAQ perspective, this is something I think we've got to really keep a close eye on. The other thing, and I mention this a lot, but maybe, well, for those of you who follow me a lot, this is a refresher. But for those of you who are new, this is something that I've been following pretty closely. This is the iShares Russell 1000 Growth ETF divided by the iShares Russell 1000 Value ETF. So it's just a visual picture of how growth is doing relative to value. Is growth in favor? It's in favor when this ratio is going up, and it's out of favor when this ratio is going down. But I think clearly in 2020, you can see growth stocks are in favor. They're not going to go up every day versus the value stocks. And in fact, September was a rough month. We had a 3-week period from mid-May to early June. It was very difficult, but we established a low, and you can see this trend line connecting these 3 lows. And if you look at a long-term chart, let me pull this up and show you on a long-term weekly chart. I don't know how long this is going to continue. It's not really sustainable in the long term. I mean, if you look at this, well, let me get it on a line chart here. But I mean, if you look at this, it's just turned parabolic almost here in 2020. So we were already moving higher, and this is what I would expect in a bull market where profits are growing. Normally, growth stocks are going to outperform value stocks in a bull market. I would want to take my chances with those growth stocks. But all of a sudden this year, and part of it is because of the steep drop in the 10-year Treasury yield. Again, when those rates are dropping, companies that can grow their earnings rapidly, that's where money gravitates to, and that's why we're seeing this. The Fed has told us they're not raising rates potentially until 2023. If rates stay where they are and the economy kicks back into full gear, and inflation's not a problem, I could see this continuing to go up. I don't know if it goes up at this rate, but I definitely could see this continuing to go up. And that's why we're sticking with growth stocks right now in our portfolios. When we look at this, I don't want to bet against this. I don't want to try and impose my will on the market and say it's gone up too much. This isn't right. It's gone up too much. It has to come back. If I had done that, I can promise you our portfolios wouldn't be where they are right now for the last month. It's, just following what the market's telling us. It seems simple, and it is to some extent, but we always try to outthink the market. We always try to tell the market it shouldn't be going up. It shouldn't be going up this fast. We got a pandemic. We got an election coming up. We got all this debt. Market shouldn't go higher. And that's what most people convince themselves of. And then, of course, that's what you read in the news. So a lot of people believe that it can't go higher. I believe it's going a lot higher. But this is definitely a ratio that I would continue to watch. As long as this continues trending up above that 20, in this case, 20-week EMA, I just don't see any reason to stay away from growth stocks. Are we going to get hit at some point? Probably. We'll probably have a bad quarter at some point because growth stocks will take a hit. Maybe it's this quarter. I don't think it's going to be, but maybe. Who knows? But we can't continually invest being scared. You got to invest based on what's working, what the market's telling us to invest in, looking for leaders, leading groups. That's, in my opinion, the best way to invest. All right, let's keep moving. I want to go through these sectors here and focus primarily on the consumer discretionary group, because as I mentioned at the beginning, this is the one group that has stayed above its 50-day moving average. This has been your, a leader. I mean, we could probably go back. I haven't really looked at these yet, but over the last week. Now, of course, September hasn't been particularly good to equity, so a little different picture. But consumer discretionary only down 2.7% in the last week. Go back the last month, and then you can see consumer discretionary up closer to the top. Even though we've had this rough September, consumer discretionary has been mostly flat over the last month. We'll go back 3 months, and you can see it just climbing the board, up 13% over the last 3 months. You also see technology climbing the board. You get the 6 months, and there's consumer discretionary actually leading technology. I don't know if many of you realize that, but consumer discretionary now has passed technology. And think about that. In the last 6 months, we've had a pandemic, and consumer discretionary is leading. That ought to tell us something. Tells me something. Tells me that this market wants to go higher. That is not how you prep for a bear market. You don't prep for a bear market by jumping into consumer discretionary and technology. All right, so a couple of the areas, if we pull up the consumer discretionary, these are the leaders over the last 6 months in this sector. So these are the industry groups: automobiles, home construction, recreational products. And recreational products was a group I recently talked about that had pulled back some. I wouldn't be surprised to see it making a little bit more of a run. And we look at the end of the day from yesterday, recreational products went up 3.6%, third on the list. Broadline retail, a lot of that's Amazon. We'll talk about Amazon in a bit. But when you look at the scooter scores, that gives you a sense. Look at footwear all of a sudden now up to 90. And that's not going to include, or doesn't include, what's going to happen today. Nike was looking really good with its earnings report. But anyhow, all these groups look really strong. But let's just pull up a couple of those top groups: broadline retail, home construction, and recreational products. Look at broadline retail. What did I say about the NASDAQ? Going down, failing at the 20, going down. Now you got the 20 coming down. Look where broadline retail sits, right below these two moving averages. PPO starting to turn up, but it's below the center line. So, I mean, we've seen move below the center line, come up, you fail at the 20. Come down again, you go up, you don't get through the 20. You come down one more time. Once you start to negotiate that 20-day, that's when you need to start thinking that, hey, maybe the worst is behind us. Right now, we're just testing. And I noticed, volume on the way back up was light. One thing I will say about volume, though, and a lot of people make, I think, a big mistake. When you get a rally, 99% of my fellow technicians, maybe 99 cents pretty high, but the majority will talk about this rally is not strong because volume is lighter on the way back up than it was on the way down. Personally, I think that is a huge mistake, because nothing creates volume more than panic. Nothing creates volume more than panic. And when you start selling off and you see the broadline retail group going from 3,500 and change down to 3,100 and change, and the volume's picking up and you're losing moving averages, you get more people that will sell during those. Look at the volume pick up here on the selling on the broadline retail group. Now, we did actually have, if you look at accumulation distribution, we did see a lot of folks jumping back in. This is actually very unusual that we see that kind of heavy volume coming back in off the bottom. But I think that institutions were accumulating and taking anybody's money that wanted to sell. I actually said that back in March and April. I'm just not saying it now. We had special sessions back here because that AD line was telling me that we were not going to stay down, that there were a lot of buyers. There were a lot of institutional buyers ready to take everybody's shares, everyone that was panicking out of the market, which was very unfortunate. But when you wake up and you see the Dow down 1,500 in futures, and you got media saying it's the end of the investing world as we know it every single morning, it wears on you. Anyhow, getting back to this, can we get through these moving averages? I don't know. Let's see. So far in pre-market, from what I was seeing, the growth stocks were underperforming value. We've had a big move the last couple of days, but today it was kind of reversing back. We'll see whether or not that sticks. If it does, then it favors potentially us going back down one more time. It could happen in this week. So we've got 3 more days. This is the 3rd worst week of the year historically on the S&P 500, and that's based on data since 1950. July 17th to the 24th is the 2nd worst, and October 21st to the 27th is the worst. And that October 21st to the 27th, by the way, does not even include Black Monday of 1987. That was on the 19th. So the 21st to the 27th of October. But I think there are a number of reasons for that. October gets a bad rap because it's had a couple bad years, 1929, 1987. That'll do it. But October overall tends to be a pretty good month. It's just that 1 week. And I think it's options. I think it's everything running up into earnings. And then we just get that selling that normally happens from about the 19th to the 25th anyway. This happens to be the 21st to the 27th. All right, let me keep rolling here. Home builders. Now, home builders actually are pretty strong, and this group has remained above its 50-day moving average, and it's not far from a breakout. But low interest rates, rising profits, rising demand in homes, all of that leading to home builders doing very well. And I think our economy continues to strengthen going forward. So I expect home construction to break out and continue to be a leader. And then the other one I wanted to bring up was recreational products. Now, this is one that I liked because of the way it was setting up on a relative chart relative to the S&P 500. But you can see it's trading down. It's been trending below its 20. Can it get back through? We're going to find out. All right, earnings. Let's talk about some of these earnings. First up, Nike. And the market's going to open here in about 3 minutes, but I can pull this chart up. I'll give you the pre-market numbers on some of these stocks. Nike beat easily, 95 cents versus 48 cents. Look at the stock up 11, almost 12% today. This is a stock, I talked about it on my shows recently. I don't know if I've had it in a daily market report. I talk about stocks so many times, so many different places, I can't keep track of where I talk about it. But I know I was talking about Nike. I really liked Nike going into its earnings report, the way it had been trading. Even though it had been moving down, I said I thought the stock was going to come out with really good numbers. And they did, 95 cents versus 48, getting a good reaction there. KB Homes reported yesterday. Stock down about 1%, but the numbers were good, 83 cents versus 50 cents. We're in an uptrend. I would watch that 20-day. I think the 20-day remains a good buy there. Stitch Fix. Now, this is one that's very heavily traded on the short side. A lot of shorts, and we broke out yesterday before earnings. That always makes me a little nervous. But Stitch Fix missed on their earnings. So even though it had been coming up, it missed on its earnings. Now, I would really watch these recent lows. I'm going to say 26.50. I don't want to see 26.50. Maybe a trend line here around 26. 26.50 is about as far as I would want to see this stock trade down because obviously it's getting hit. It's very heavily shorted. That's great when you're breaking out. But when you got new news and you move back down, you have to respect the fact that the stock is heavily shorted. They missed their earnings number. I need to see it reverse. Now, if it trades down and comes back up and can break back up above 30, I think that would be very bullish on the stock. So we'll want to keep an eye on that. Let's see. Next up is General Mills reported this morning. General Mills up 1.2%. They beat $1 versus 87 cents. Another one that I really liked going into earnings, and this is one I wrote about on September 9th in the Earnings Beats Digest. So anybody getting that Earnings Beats Digest, I talked about Cintas. Cintas, I was looking right, that was the top of the support area. This area right in here from about 295 to about 310. was the area that I featured as support level. And I said, if Cintas got back down there, we could start to get a pre-earnings run. Well, we did it off of that for 2 days. And now today you can see the stock up another $11 back to 335. So we are getting that bounce on Cintas. Still got to get through 345 to break out. And I think eventually we're going to. I think maybe what we're going to see here is a little bit of a cup, maybe a handle, and then I'd be looking for a breakout in the fourth quarter. But Cintas looking pretty good. WOR, market just opened. So let's just take a look at the chart. Not really doing much. Stock up less than 0.5%. They missed 25 cents versus 44 cents. Look at the AD line, not exactly confirming. And I wanted to pull this one up on a relative strength basis. Yeah, last 6 weeks or so, it's been turning down versus the steel. But steel overall has just not been a good group. So Worthington, actually, the fact that it was, doing this well and breaking out above the June high, it actually was outperforming its steel peers. But it is now in a downtrend. They've come out with earnings, I think, and now it's turned red. I don't know. This isn't the kind of stock. I want leading groups, and I want leading stocks in leading groups. This one doesn't qualify. Last one I'll give you for earnings here, Jinko Solar, JKS. Nice move here, trying to make a breakout above $29. This one has started to show some really nice leadership heading into its earnings report. 93 cents versus 40 cents. That's how it came in, more than double. So you get these companies that posting these kinds of numbers. If the market believes that it's sustainable and that this growth is the norm going forward, they're going to get repriced. Stocks are going to get repriced a lot higher. That's what we've seen throughout 2020, throughout since the start of this pandemic. Companies that can grow their earnings in this pandemic with the historically low interest rates are being rewarded. Jinko could be the next one. So we'll watch, see if we get that breakout today above 29. All right, last thing, 3 you must see. I wanted to go through a couple of these stocks here. Let's see. First, I'm going to start with Amazon. So I mentioned Amazon when I was talking about broadline retailers, and here you go. Amazon trying to get through the 20. Hasn't done it yet. Let me give you the update. This was before today's action. And actually holding in there pretty good, though, down $10, but it's had a huge move. Amazon moving back through the 20 and the 50 would be very bullish for the market. Obviously, it would for broadline retail and for consumer discretionary. I think Amazon represents like 23% of the XLY. I don't know if that's still the same percentage. I know it's a big chunk of the XLY. So when Amazon gets rolling, so too does consumer discretionary. But I think it's really cool that Amazon has been trading pretty low relative to its moving averages. I mean, it's taken a big hit, but consumer discretionary is one of those groups that stayed above its 50-day moving average. I remember a lot of folks saying, well, consumer discretionary, you don't want to go in there because it's being driven higher by Amazon. If you strip Amazon out, well, Amazon's been leading to the downside and consumer discretionary is hanging in just fine. So I don't know. To me, it I think we could go into a pretty good debate there. I'm not a fan when folks start saying, well, let's look at the equal weight. I'm like, why would you want to equal weight? Why would you want to look at a company, $100 million consumer discretionary company, and look at it the same as Amazon, which is a $1 trillion company? Why would you want to equal weight? What does that prove? I never have understood it. Our indices, our S&P, they're all market cap weighted. If you're going to invest in the spider, who cares whether that $100 million company is doing better than Amazon or not? I don't know. Anyway, I could go into a long dissertation here. I'm going to stop right there. LEN, second one I want to talk about. This is Lennar. I mentioned the home builders. Lennar is trying to make a breakout. Lennar is one of the top stocks in this group. Look at the AD line. It's moved to a new high. Look at the relative strength versus the S&P straight up. It's actually pulled back a little bit versus home construction, although it's starting to strengthen again. And that's mostly because of this sideways consolidation. Now that we're moving back up, I think if we get a breakout, you're going to see the relative strength of Lennar take back off again to the upside. But when you go down to the bottom here, look at home construction relative to the S&P 500. I mean, it's strong. So these are the types of groups that you want to be in. If home construction is outperforming the S&P 500, you got a much better chance of beating the S&P 500 with a home construction stock. I don't know. That's kind of makes common sense to me. Anyway, we're going to finish with an IPO, recent IPO. I had never even seen this stock until just recently, but Applied UV. And I looked at this chart, and I get the question sometimes: how do you trade a um, a an IPO? Well, it's hard because a technician uses price history. You use history of price to determine what you think is going to happen in the future. That's really what technical analysis is all about. It's trend following. There's no trend here. This thing went straight up. I mean, obviously, it looks like the IPO was priced at 5. It gapped up to 580, ran to 13. 4 days later, was back down to 5. 1 day later, was back to 8 and change. And then it's kind of was squeezing into this triangle I see. And then the volume picked up and it exploded back to the upside. Now, I don't know where this thing's going to go. What I am fairly confident of is that you're going to see some big swings. If you're a trader and you like volatility, this is one that you might really like. Now, once the volume settles down, though, I can already see some of the volume bars here pretty low relative to this 1 million line. So I'd be a little nervous that once the excitement settles down around this stock, that you might be in a fairly illiquid stock. It's not a problem yet, but it could be. Right now, it's just crazy and all over the place. But I don't know. For me, I probably would just, I'd probably sit it out. And if I did get in and it went in my direction, I'd probably take my profits pretty quickly. I mean, I know you look at it and you say, well, I'm going to hold it till it gets 13. Well, if it goes to 11 and then goes back down to 5, you're not going to be very happy waiting for 13. So I just, one of my favorite sayings in the market from a trading perspective is you never lose money taking a profit. And that is true. You can't lose money if you take a profit. Anyhow, that's it for today. Let's get a quick update on the market, and then we'll wrap this thing up. All right, Dow Jones up 172, S&P up 3, NASDAQ down 47. So we are definitely seeing that rotation back away from, I'm going to pull up that ratio here. Let's go back to that hourly chart. Actually, I'm just going to do a little 10-minute chart. Yep. So at the open anyway, we're getting a pullback here, IWF versus IWD. But you can see what's happened the last couple of days. Huge move to the upside here. So pullback short term. If this continues all day, then I think, we've got a chance of maybe going down one more time. If we rally and we go right back up again later today and we take out this double top over here, break to about a 2-3 week high, then I think it's starting to paint the picture that the bottom is in. So today and the rest of this week going to be pretty critical. And this is one of the ratios I'm watching very, very closely. All right, that is it for today. So hope everybody has a good day. I'll be back tomorrow over at Stock Charts TV for the next episode of Trading Places Live, even though technically it's recorded. Hopefully we'll get back to some live shows over at Stock Charts soon. But for now, we'll just keep doing those recordings. But I will be doing another one recorded for tomorrow morning, so you can check that out. Otherwise, if you're not already a member of Earnings Beats, I'd love to have you come on board. I'll be sending out my daily market report later today to all of our members. And we'll talk later. Everybody have a great day. Happy trading.